Hello, and welcome to the 6th lesson of the Bybit 101 course. In this one, we will see how to make passive income with Bybit Earn. Let's get started. From the Bybit main menu, click on the Finance button and after on Earn. There are over 40 products to choose from, with APR ranging from 1.5% to over 500%. APR stands for Annual Percentage Rate. Let's say that you invest $100 into Bitcoin, and it has an APR of 10%. After 1 year, you will be getting $10 worth of Bitcoin, assuming the price did not change. Let's pick Bitcoin. It has 4 options: flexible savings, fixed term, dual asset, and liquidity mining. And depending on the option that we pick, we will have a higher or lower APR. The advantage of flexible savings is that you can move your funds freely. Even if the returns are a little lower, you're having great flexibility. Fixed term, as the name suggests, you are locking your crypto assets for a certain amount of time, between 30 and 60 days, and in exchange you are getting better returns. This strategy is really great if you are looking to hodl. The dual assets is a riskier option, but it offers even greater returns. You can choose between buying low or selling high. Let's assume that you want to buy Bitcoin at $20,000. If the price gets lower and the target has been reached, after the subscription period has ended, you will be buying Bitcoin and getting an interest, which is also in Bitcoin. But if it gets higher, then you are getting your money back in USDT and also an interest. The sell high option. Let's assume that you want to sell Bitcoin at $25,000. If the price gets higher and the target has been reached, after the subscription period has ended, you will be selling your Bitcoin and you'll receive USDT in return and also USDT in interest. If the price gets lower and the target has not been reached, and after the subscription period has ended, you will be keeping your Bitcoin and also receive an interest in Bitcoin. And a fourth option, liquidity mining. As a liquidity provider, you are helping the exchange to have an easier time offering liquidity to its users. Let's assume Bob wants to buy Bitcoin. Because you have provided liquidity to the Bitcoin/USDC trading pair, Bob will always have Bitcoin to buy. Same goes to USDC. If you invest $1,000 into the liquidity pool, $500 will go into Bitcoin, the more volatile coin, and $500 will go in USDC, the less volatile coin. The higher the volatility, the bigger the API that you will receive. API stands for Annual Percentage Yield. As a disclaimer, yield farming can be very lucrative, but you should be aware of impermanent loss. Let's take the earlier example. If Bitcoin is at $20,000 and you have invested $1,000 into liquidity, $500 will go into Bitcoin and $500 into USDC. But if Bitcoin gets to $40,000, the $500 will turn into $1,000. In this case, you would have benefited more just from buying $1,000 worth of Bitcoin. Congratulations! You just finished the first chapter. How do you like the course so far? Make sure to also leave a review. Any kind of feedback is much appreciated. The course will be getting a little harder, but I am sure that you will manage. In the second chapter, we will be talking about spot trading, margin trading, and leverage trading, trading bots, and copy trading. See you in the next chapter.